Hello everyone, welcome to this Q&A session on module 3 wherein we studied about the GST rate structure and invoicing. In this module, we covered the topics like GST rates, that is 0%, 5%, 12%, 18 and 28%. Then we learned about HSN and SAC codes and the classification of goods and services. We also learned about the GST compliant invoice format and what is debit note, credit note and bill of supply. Then we covered the reverse charge mechanism and finally input tax credit mechanism and eligibility and conditions for availing input tax credits. So now let us move with the Q&A session on module 3. First question, a local dairy farmer sells fresh unprocessed milk, eggs and unbranded paneer directly to the consumers. What GST rate applies to these products and why is the rate structure important for essential goods? So we have already learned about the importance of GST rates. So the GST department classify the goods based on its nature and essentiality. Lower tax bracket goods are either essential or falls under the basic necessities, and higher rate goods are either sin goods or luxurious goods. Midway there are goods which are of daily use which have been kept under the middle segment tax bracket. So in this case, fresh unprocessed milk, eggs and unbranded paneer are exempt from GST, the rate being 0%. This rate structure is crucial because it ensures that essential food items remain affordable and accessible for the general public, minimizing the tax burden on basic necessities. So basic necessities are kept under lower tax brackets. Next question, a restaurant charges customers for packaged paneer, a popular Indian sweet mithai, and aerated drinks. What are the applicable GST rates for each of these items and how does this reflect the GST Council's approach to different categories of goods? So again, the GST Council has taken into consideration the basic necessities and the luxurious goods and kept them under different tax brackets. So in this case, the packaged paneer will fall under the 5% GST bracket. Indian sweets, that is mithai, also falls under the 5% GST bracket, and aerated drink falls under the 28% GST with some additional cess. So this shows the GST Council's approach of taxing basic necessities at a lower rate, that is 5%, and luxury or non-essential products at a higher rate, that is 28%, with additional cess on certain items to manage their consumption. Similarly, sin goods like tobacco or cigarettes are also taxed at a higher rate of 28%. Moving ahead, discuss how the GST rate structure for goods and services with its 5 main slabs, that is 0%, 5%, 12%, 18% and 28% aims to achieve fairness and equity in taxation. So the GST rate structure is designed to ensure fair and equitable taxation by categorizing goods and services based on their nature, essentiality and affordability. Essential items and services like unprocessed food and education are placed in 0% or lower slab, that is 5% for affordability. Standard goods and services fall under the mid-range slab, that is 12 and 18% to balance the revenue generation and affordability. Luxury items and sin goods like tobacco, luxurious cars are subject to the highest rate, that is 28%, sometimes with additional cess to manage luxury and non-essential consumption. So in this way, different tax rates allows the accessibility of essential goods to all range of people. Next, a business manufactures and sells electronic components which are goods. When does this business need to mention the HSN code on its invoices and the returns based on its turnover? So what is HSN? HSN stands for Harmonized System of Nomenclature. It is a globally accepted classification rules for goods, and for services SAC is the classification mechanism. So the requirements for mentioning HSN codes depends on the business turnover. For aggregate annual turnover up to rupees 5 crores in the previous financial year, 4-digit HSN code is mandatory for B2B invoices and optional for B2C invoices. For aggregate annual turnover more than rupees 5 crores in previous financial year, a 6-digit HSN code is mandatory for all invoices. Importers and exporters must always use 8-digit HSN codes. So in the first point we have aggregate annual turnover up to rupees 5 crores in previous financial year. A 4-digit HSN code is mandatory for B2B invoices and optional for B2C invoices. With effect from the return for the month of June 2025, the requirement for mentioning HSN of unregistered supplies are also mandatory. You will not be allowed to proceed for filing GSTR1 return if you have entered data in the B2C segment but have not entered the HSN details of B2C segment. Next, list the mandatory information that must be included on a GST compliant tax invoice issued by a registered supplier for a taxable supply of goods or services. So a GST compliant tax invoice must include the supplier's name, address and GSTIN, a unique consecutive serial number. This serial number, that is the invoice number, should not exceed 16 characters or else the portal will not accept. Then the date of issue of invoice, the recipient's name, address and GSTIN or UIN if registered, the HSN code, SAC codes, description of goods or services, quantity and unit for goods, total value and taxable value, the applicable GST rates, that is CGST, SGST, UTGST or IGST, along with cess and amounts, place of supply, address of delivery if different, that is in case of bill to ship to transactions, indicating if tax is payable under reverse charge mechanism, and the signature of the supplier or authorized representatives. So these are the mandatory informations that must be present in a GST compliant tax invoice. So a tax invoice is the primary document on the basis of which the recipient of goods or services files his GST returns. So if the recipient of goods or services does not have a invoice against the goods or services received, he won't be able to claim the input tax credits. As a supplier, the supplier must mention certain mandatory details in the GSTR1 return, and if such particulars are not present in the GST compliant tax invoice, GSTR1 return cannot be filed. For example, if the invoices issued by a supplier of goods or services contains invoice number in excess of 16 characters, that is the invoice number is in excess of 16 characters, then the portal will not accept. Similarly, if he has not mentioned the GSTIN of the recipient of goods or services, then he will file the GSTR1 return under B2C category, whereas the recipient will insist on filing of GST returns under the B2B segment. Hence, if he doesn't file the GST return under B2B segment, then the recipient will not be able to avail the input tax credits. Similarly, any misclassification of tax rates or taxes as CGST and SGST or IGST will also affect the availment of input tax credit to the recipient. Hence, every businesses must comply with the requirements of invoicing as per the GST laws. Next question. Explain the primary difference between a debit note and a credit note under the GST, including the situations that necessitates their issuance and their impact on GST liability. So, debit note. It is issued by the supplier to increase the taxable value or the tax charged on a supply that was initially undercharged or where additional goods or services were supplied. Ultimately, it will increase the supplier's GST liability. Common reasons include undercharging, additional supplies, or price revision upwards. Next is credit note. It is issued by the supplier to decrease the taxable value and tax rate charged on a supply, typically due to sales return, overcharging, or discount given post invoices. So it decreases the supplier's GST liability. Common reasons includes goods return, overcharging, or post-sale discount. Both documents are used to rectify errors or situations after an original tax invoice has been issued. So to understand a credit note, suppose a seller sells a goods for rupees 100 to the recipient and charges GST on this amount. After the sale invoices has been raised, the recipient of goods return goods valuing rupees 20. So in this case, the supplier will raise a credit note for rupees 20 and any GST on this rupees 20 will also be reversed, and hence the liability on such amount of return will be reduced. Similarly, suppose if the supplier has supplied 30 quantity of certain goods, whereas he has charged only for 20 in the invoice inadvertently, then for the rest 10 pieces he will issue a debit note, and the GST liability against such supplies or such additional supplies will increase the liability. Moving ahead, under what circumstances is a bill of supply issued instead of a tax invoice? Who typically issues a bills of supply? So a regular taxpayer is required to issue a tax invoice, whereas composition dealers are required to issue bill of supply. The reason for this difference is that any composition dealer is not allowed to charge GST in the invoice. Hence, it cannot be termed as a tax invoice. Rather, it is a bill of supply. So, a bill of supply is issued instead of a tax invoice in two main scenarios. When a registered person is making a supply of exempted goods or exempted services or both, and when a registered person is a composition dealer. So, a person who is supplying exempted goods or provisioning exempted services shall also not raise a tax invoice, as he is not charging any GST in the invoice, and hence he should raise a bill of supply instead of a tax invoice. Next, we have a registered person procures legal services from an individual advocate. Who is liable to pay GST in this scenario, and what mechanism is applicable? Explain the concept of self-invoicing in this context. this is an example of reverse charge mechanism. Under the reverse charge mechanism, the recipient of goods or services is required to pay GST instead of the supplier. So in this scenario, the registered business receiving legal services from an individual advocate is liable to pay GST under the reverse charge mechanism. Under the reverse charge mechanism, the recipient, that is the business, pays the GST directly to the government instead of the supplier. In this case, advocates are the supplier of services. Since the supplier, that is an individual advocate, might not be registered or liable to issue a tax invoice, the recipient, that is the business, is required to issue a self-invoice for the supply of services received. This self-invoice serves as a record for the transaction and the GST liability discharged by the recipient. So there are many other services also on which reverse charge mechanism is applicable. For example, goods transport agency. Then in case of renting of property by a unregistered person, in this case the lessee or the tenant has to pay GST if he is registered person under the reverse charge mechanism. List the primary conditions that a registered person must meet to be eligible for claiming input tax credit under the GST. So to answer this question, we have to first understand what is input tax credit. So input tax credit is the mechanism that allows businesses to reduce their tax liability by deducting the taxes they have already paid on purchase from the tax they owe on sales. That is, reduction of input taxes that has been paid at the time of purchase against the output tax liability. This mechanism helps to reduce the cascading effect, or I should say eliminate the cascading effect of taxes. So to claim input tax credits, there are certain conditions that must be satisfied, or else the taxpayer is not allowed to avail the input tax credits. First, they must possess a valid tax invoice or a debit note issued by the supplier. So tax invoice or a debit note are the primary documents on the basis of which input tax credits can be availed. If goods have been received but the supplier is not in the recipient is not in the possession of invoice, he cannot claim input tax credit. They must have actually received the goods or services. So only invoices are not mandatory, but actual receipt of goods or services is also a primary condition for availing input tax credit. The tax charged on the supply must have been paid by the supplier to the government. So the payment of taxes by the supplier of goods is a primary condition to allow the recipient of goods or services avail the input tax credit. So any taxes that has been charged from the recipient but has not been remitted to the government disallows the availability of input tax credit to the recipient. They must have filed all required GST returns, particularly GSTR 3B. So in the above point, we have just discussed that the taxes must have been paid to the government. So taxes are paid via GSTR 3B return. So if the supplier has not paid the taxes in his GSTR 3B return, then the recipient will not be able to avail the input tax credits. Then if the payment for supply is not made within 180 days from the invoice date, ITC claimed might be subject to reversal along with interest. So under this condition, if the supplier of goods or services did not receive the payment against such supply within 180 days, then the recipient of such goods or services who has not made the payment within 180 days must reverse the input tax credit that was availed at the time of invoicing, and once the payment has been released by the recipient to the supplier of goods or services, it can be reclaimed by the recipient. So moving to the last question, identify at least 5 categories of goods or services on which input tax credit is generally not allowed, that is block credits under section 17 subsection 5 of the CGST Act 2017. Are there any exceptions to these restrictions? So as per the normal rules, a supplier of goods or services can reduce his tax liability by utilizing the input tax credits against the purchases, that is the taxes that he has already paid at the time of purchases. But there are certain exceptions, and there is a list of block credits under section 17 subsection 5 of the CGST Acts. If the goods or services falls under this category, then against such supplies input tax credits cannot be claimed by the recipient. So input tax credit is generally not allowed on the following categories, that is block credits under section 17 subsection 5 of the CGST Act 2017. Motor vehicles and conveyances with a seating capacity of less than 13% including the driver, except when used for further supply, transportation of passengers or imparting training. So motor vehicles have been defined as those motorized vehicles bearing power of more than 25 cc. So input tax credits against motor vehicles and conveyances with seating capacity less than 13% cannot be claimed. Such inputs can only be claimed by those who are engaged in the business of further supply of such motor vehicles, that is trading of motor vehicles, then transportation of passengers and imparting training, that is driving schools. Then food and beverages, outdoor catering, beauty treatment, health services, cosmetic and plastic surgeries, unless used as an outward taxable supply of the same category, or if the provision of such services is obligatory for the employer under any law, then only inputs can be claimed, or else in general laws input tax credits against these services cannot be claimed. Then membership of a club, health and fitness center. So clubs or health and fitness centers are meant for personal purposes, or even if they are for business purposes, they are for mutual benefits of the members, and hence input tax credits cannot be claimed for non-commercial activities. Then rent a cab, life insurance and health insurance, except where the government mandates the provision of such services for employees, or if it's an outward taxable supply of the same category. So in this case also input tax credits cannot be claimed. Goods or services used for construction of immovable property other than plant and machinery on one's own account. So any construction or renovation of immovable property which is not meant for further sale also restricts the availment of input tax credit against the materials or the services. Then goods lost, stolen, destroyed, written off or disposed of by way of gift or free samples. In these cases also input tax credits cannot be claimed. So exceptions do exist for some categories, such as motor vehicles used for transporting goods or passengers, providing training or further supply, and services like food and beverages or insurance if required by law, or used for outward taxable supplies of the same kind. In such scenarios, input tax credits can be claimed against such goods or services. So this is it for this module. We'll now move to module number 4. Thank you.